All the experts in. Indranil Sengupta, the chief economist at DSP Merrill Lynch, is with us. So is Saugata Bhattacharya, the chief economist at Axis Bank. In a bit, we will also be joined by Dr. Soumitra Choudhury, the chief advisor at ICRA and also advisor to a member of the Prime Minister's Advisory Council. Well, let me begin with you, Indranil. What do you make of this number? We are at 0.5% now, less than that, 0.44. It's very clear now that before March 31 is out, we are going to look at a minus number. Should the Reserve Bank look at this as signs of emerging deflation and serious demand compression and act?
Well, I think there are three things here. First, there is no doubt in my mind that we will see, quote-unquote deflation for the next 2 to 3 months. But this is going to be deflation arising out of base effects, really speaking. Secondly, this is really deflation in the WPI sense. The CPI, as you mentioned earlier, is actually in double digits, and I expect that to come down to around 5 to 7% going forward. Thirdly, we think the Reserve Bank will continue to ease monetary policy. We are looking at another 50 basis cut in the policy rates, in the reverse repo rate, and a 100 basis point cut in the CRR. But this is really not deflation in the sense of demand compression as much as deflation in the sense of base effects.
Well, let me get the person who is closer to the government in Dr. Soumitra Choudhury, the member of the Prime Minister's Economic Advisory Council and Chief Advisor at ICRA. Dr. Choudhury, what do you make of this number? Now at 0.44, much lower than what people were estimating. The week-on-week number, the index has also fallen by about 5 or 6 ticks. I will be able to tell you in a minute what the exact fall is, but the week-on-week fall is fairly sharp. Would you say now, all the parameters of looking at rate cuts and monetary policy will have to change a bit and more action may be called for?
I couldn't but agree more with your previous speaker. I think he put it very well. This is not deflation in the sense of a continual weakening in prices. This is deflation of, you can get negative inflation rates probably for some time between the end of March and early June because of base year effects. Of course, certain prices have in fact come down because world prices have declined. But I think you'd probably see inflation back, or manufactured goods inflation at least back to the 2 to 3 to 4% range shortly after July. If you look at the 3-month seasonally adjusted rates, whoever does that, you'd find that in fact the negative effect, the pulling down, was much more strongly pronounced at the end of December and in January than it is now. It's sort of headed back to zero. So, I mean, this is not deflation. Let's be clear on this. It certainly is going to mark the beginning of a relatively low inflation period in 2009-10 and perhaps even in parts of 2010-11. That certainly gives the RBI room for monetary easing, which it might have to, that particular stance it may have to sustain for some time, as long as capital flows do not return any sizable amount, and you need finance for business. I think that's the whole point.
Well, Dr. Choudhury, how do you reconcile this CPI number with this kind of a WPI number? The CPI number simply refuses to come down from that 10% odd mark. We had 1 month of maybe 9.7 in December, but otherwise it stayed at the 10% mark. And even if you looked at the WPI, you still have a food index running at plus 5.5% or thereabouts. So do you think that aggressive quantitative easing, because at this point in time monetary policy easing is not working, so the RBI quite clearly is into quantitative easing in its own way. Do you think this is an instrument the RBI can use at all?
I mean, there are reasons to do many things, but not the one that you just invoked. CPI is running high, close to double digits, because food price inflation is not 5%, it's about 8 to 9%. If you look at the other components of the CPI basket, which is very different from the WPI basket, it contains primary food, it has sugar, it has edible oil, it has cotton textiles. Edible oil, sugar is running around 20% inflation, cotton textiles are about 14 or 15% inflation, and this is the reason why the CPI basket is showing up in much higher numbers. Eventually that too will come down. This is not going to last for a very long time, that too will move south. It's got nothing to do with quantitative easing. That's, as I said, when you adopt a relatively easy monetary stance in order to provide financing for business Then you have a lot of tools at your disposal. These are standard tools. They weren't invented yesterday. They were invented 50 years ago. And you continue with those standard tools to try and bring liquidity into a market where liquidity may, for whatever reasons, be drying up. I mean, that's something they do on a day-to-day basis, on a week-to-week basis.
Okay, let me get Saugata in at this juncture. Saugata, what have you made of this number? What is the trajectory going forward? What kind of a low in inflation can you see? And what does all that mean to the bond market?
Hi, Lata. I think to be a little pedantic in terms of being an economist, I would rather characterize this phase as disinflation rather than deflation. Mm-hmm. Deflation implies a systemic weakening of demand over a sustained period of time and so on. This, as the other speakers have said, is mostly a technical statistical quirk in the system. This is exactly on the lines that we have been predicting, as you know, over a long period of time. But what I'm thinking is that the next week, couple of weeks itself, you'll see a slowdown of this very sharp deceleration. And it will take 3 or 4 more weeks to get to the zero level. And then after that, you'll see a 2 or 3 months worth of negative inflation. Having said that, I think in terms of monetary policy, I think you can clearly see the reluctance of the RBI to carry rate cuts very much further, because I mean I'm sure they'll probably have to do one more rate of rate cuts, but they are more worried about the CPI inflation, and there are many structural factors for the CPI inflation. I mean, you know, with the increased minimum support prices for food grains, these are not very cyclical commodities that we are talking about. There are more structural factors underlying the non-food price.
That's precisely the point, Saugata. That's precisely the point. There are these structural problems. I mean, you're adding an Australia to your population or nearly thereabouts. There is a latent demand there. No, not all need becomes demand. It has to be backed by purchasing power. But there are structural issues both on the demand side and on, as you said, in the crop food side, which will not permit certain prices to come down very easily. In such a context, do you think the Reserve Bank is really between a rock and a hard place? I mean, although you will see a lot of negative inflation numbers, and some of it is because of demand contraction, don't you think that it is really not in the same position as other central banks are to do either quantitative easing or, monetary policy cutting or rate cutting? Indranil, what would your guess be? Do you think the Reserve Bank really has any options?
Well, I think the Reserve Bank will ease monetary policy, like I said. Clearly, the inflation is not going to be a worry for the next 5 to 6 months. At the same time, the fact remains that money supply is still 19%, and if growth does come down to around 5% level or so, then clearly going forward at some stage, we will have to worry about inflation, maybe 8 months to 1 year down the line. So yes, the Reserve Bank will have to balance factors, but then today I think the force of circumstances are such that some more monetary easing is certainly likely, and that is what we expect.
Right. Soumitra, just going by copybook style, one would say as far as cost push inflation is concerned, it's probably out of the system, at least for now, whether it's crude, metals, commodities. What about demand push inflation or demand pull inflation at some point? What can the government do at this point? You can't just keep depending on monetary policy, because the issue is stimulating demand at this point.
Right. No, I mean, the government is trying its level best. The government, the RBI, everybody seems to be working, at least in the kind of sync that we expect of the government to be working. As my colleague said, I mean, the RBI will definitely try to balance its various pulls and pressures. I mean, trying to expand the monetary base, try to accommodate the government's borrowing program in order to accommodate.
Sugata, could you just hold that thought? I also wanted to just bounce that question off to Soumitra. Soumitra, if you just heard my question, essentially I was saying, the main key reasons for inflation was cost push. I mean, pretty much out of the system. I mean, we don't have those cost pressures. But what about stimulating demand? How does the government do that? You can't keep depending on the RBI to play around with monetary policy if demand itself is under question.
I don't think the demand is the issue. I mean, in this country, it's not so much demand as investment, which slows things down. And I think that's the channel where the international developments has been very, very negative.